Have you been putting off your taxes? Maybe you miss a year or two, and before you knew it, several years went by. Now you're stressed, you're worried about penalties, and maybe even afraid that the IRS will come after you. First off, I want you to take a breath because you are not alone. The IRS estimates there are over 10 million non filers in the US. And the good news, there's a clear process to fix this. I want to walk you through it step by step. Before we dive in, I'm Andrew Samaniego. I'm an enrolled agent and Navy veteran. I'm a husband, father, and I'm a tax problem solver here in San Diego. I've helped hundreds of people across the country deal with the IRS and state tax issues, from unfiled returns to liens to levies and big tax debts. My mission is simple: to give you the same strategies I use every day to help clients finally put their tax problems behind them. If you want to go any deeper, I've put together a free guide called the IRS Battle Plan. It walks you through step by step on how to start solving your tax problem. You can download it in the link in the description below. Now back to the video. Step 1 is to understand what happens when you don't file. Here's why you can't just ignore the back tax returns. 1, you get a failure to file penalty. It's 5% of the tax owed per month, and it's capped at 25%. The next is the failure to pay penalty. It's 0.5% a month, and that's also capped at 25%. And these stack, meaning the penalties grow quickly. And it's not just penalties you have to worry about, you also have to worry about interests. It compounds daily on top of the taxes and penalties. The next thing you have to look into is something called the substitute for return. If you don't file, the IRS files one for you, using only the income it knows about. So no deductions, no credits, and this usually makes your balance look a lot larger. An example of this: if you earn $50,000 and you didn't file, the IRS might prepare a return showing you owe around $7,000. But if you filed properly with your deductions and credits, you might really only owe $2,000. Heck, you might even get a refund. Step 2 is gather your information. You can't file without knowing what income the IRS already knows about, or they see. The IRS keeps a record of income transcripts, which include W-2s from employers. It also includes 1099s from independent work, your 1099 interest and dividends, your mortgage interest forms. You can get from these transcripts are the retirement contributions and distributions if you had any for that year. Usually any tax pro can go pull these transcripts for you and create a report, and they get it from filing a Form 2848, the power of attorney, or the tax information authorization form, the 8821. This way you're not guessing on if you can prepare accurate returns that line up with the IRS's records. Step 3, how many years do you need to file? Here's the good news. The IRS generally requires 6 returns to bring you back into compliance. If you haven't filed 15 years, that doesn't mean you need to file 15 years of the back tax returns. Usually 6 will do. But there are exceptions. If you're self-employed with high income, the IRS might push for more. If you had big refunds that are expired, filing older returns can still reduce balances, but you won't get those refunds back. An example of this is I've seen clients who filed 8 years at once, and the oldest 2 years were reduced from they owe but didn't generate refunds. They just applied that to the newer balances. Step 4, file the returns properly. When you're filing old returns, you cannot e-file anything older than 3 years. Those must be mailed in. Always send certified mail with the return, with the receipt, so you have proof. If the IRS already filed a SFR or a substitute for return on your behalf, the new return will replace it. Don't forget state taxes. Many states piggyback on those federal filings and will pursue their own collection if you ignore them. Step 5, know your rights and your deadlines. So when the IRS says you owe, they'll send you a series of notices from the CP14, the 501, 3, 4, and then finally the final intent to levy. The final notice is serious, and you only have 30 days to request a collection due process hearing. Filing that request stops collections and gives you time to fix things. Also remember, the IRS only has 10 years from the assessment to collect, which is called the Collection Statute of Expiration Date, or the CSED. Sometimes waiting it out strategically makes sense, but usually you'll need to file and work out a deal. Step 5.5, why you must act early to avoid a revenue officer. So here's something a lot of people don't realize. If you wait too long, your case might get assigned to an IRS revenue officer. Revenue officers are The IRS field collectors. Their job is to secure delinquent returns and collect as much as possible as fast as possible. Why is this a big deal? One, they're more aggressive. Unlike the automated collection system or the ACS, which usually are the ones who send you the letters, revenue officers can demand financial records, they can summon you to meetings, they can even recommend you for the levy or seizure. For number two, they're harder negotiators. If your case is large enough to reach them, usually the six-figure cases or for multiple years, they insist on tapping into your home equity, your retirement accounts, or loans before approving any type of payment plan. Another thing is they're less flexible for you. If you had acted earlier, you might have qualified for a streamlined payment plan with no financial disclosures. But once an RO is involved, expect full financial scrutiny. An example of this is a taxpayer owing $80,000 might have been approved for a 72-month payment plan through the ACS. But once that case hit that revenue officer's desk, the IRS demanded proof of income, assets, and even pushed for selling property before approving anything. This is why it's so important to start early. The sooner you file your returns and reach out to resolve things, the more options you'll have, and less painful this process will be. Step 6, explore your resolution options. Once you've filed, the IRS is going to want a plan for any balance due. Your main options are installment agreements, in which you would pay the balance monthly. Currently not collectible. If you can't pay, the IRS may place your account on hold. They'll check your financials, but it'll stop the levy. The offer and compromise program. This is the let's make a deal program. If your reasonable collection potential, or the RCP, is less than what you owe, you can settle for lower that amount. An example of this is if your assets plus your income show you can only ever pay $15,000 before this tax set expires, then your $100,000 tax debt will settle for $15,000. Last option is bankruptcy. Speak with the lawyer if you're considering that route. A key point I want to make is you must be in compliance with your returns filed and your current year's taxes being paid for before the IRS will approve any of those deals. Step 7, stay compliant. This is the make or break step. Once you resolve your past, you must stay compliant. For employees, that usually means you're going to adjust your W-4 so you have enough taxes withheld. For a self-employed, you're going to pay quarterly estimated taxes. If you fall behind again or on any agreement or offer a compromise, it can default, and the IRS will come back at you harder. So, if you haven't filed in years, here's your roadmap. Face it, stop the penalties, pull your transcripts, and file at least 6 years. Replace any IRS-created returns or SFRs with accurate ones. Then work out the best resolution, whether it's payments, the hardship status, or even the settlements. The sooner you start, the more control you have. If you found this video valuable, hit like, subscribe, and share this with someone who's been putting off their taxes. And let me know in the comments if you liked a deep dive on offer and compromises or payment plans. Thanks.